Hi, everybody. Thanks for joining me. Before we get started, please hit subscribe to my channel to keep up with all of my latest investing and personal finance content. And also, please be sure to check the link on your screen for a special offer from our sponsor, The Motley Fool, where you can get the top 10 stocks to buy right now. So every month I do a list of stocks that I think are exceptional deals right now. And admittedly, it's kind of tough in the current market environment. There are a lot of bargains. We're still in a bear market. A lot of companies that I follow are down 50%, 70%, or even more. So it's admittedly tough to narrow it down to a list of just a few stocks. So, with that in mind, in November, there are five stocks that have made it to the top of my watch list. Number one, and this is in no particular order. So, the first one I'm going to talk about is SOFI, ticker symbol SOFI. This is by far the riskiest stock on this list, just to get that out of the way. If you do not have a high risk tolerance, this is probably not a company you want to invest in. SoFi is looking to disrupt the future of banking. Their motto is break up with bad banking. They aim to do things like checking, savings, lending better than the traditional big banks. The stock is down 80% from its highs. It recently reported earnings, and the numbers are pretty fantastic. It raised its guidance for the year. Its profit margin is better than expected. Its member growth, it grew its member base by 61% year over year. It has 4.7 million members now that have a total of 7.2 million financial products between them, including loans and banking products and things like that. That's up 69% year over year. It's Everything's moving in the right direction. The market's not giving the stock any love. It trades for below its book value, despite its massive potential and solid balance sheet. So that's one that's on the top of my list to add to. Number two, this is on my has been on my list in previous months, is Boston Omaha Corporation. Ticker symbol is BOC. They are often compared to an early stage Berkshire Hathaway, and while I don't necessarily think they're ever going to be, $500 billion company like Berkshire Hathaway is, they don't need to. They have a lot of upside within their existing businesses, and they're pivoting to a fund based business model that has a lot of potential. There's a saying in investing that the best way to make money is by using other people's money, and they're really trying to do that to capitalize on some opportunities they see. Boston Omaha has a very good problem to have in that they see more opportunities than they have capital available. For example, one area they see is fiber internet infrastructure, especially in new homes. The acquisition cost is very low, and the cost of internet service would be billed to the HOA, so it's guaranteed income, and they see more opportunity than they have income, so they are or than they have capital, so they're aiming to raise a lot of money in order to go after this. They're going to contribute, I think, 10% of the fund, but they're looking to raise up to $500 million to go after this. And that's just one example of kind of where they could generate not only investment returns from themselves, but performance fees if they make their other investors money. There's limitless potential to that type of business, especially for a micro cap company like Boston Omaha. Their core businesses of billboards, rural broadband, and insurance have a lot of upside and are meant to weather any storm. So this is one that is one of my largest investments and one that I continue to add to incrementally over time. Number three, Disney is looking like a very opportunistic investment right now, with the stock over 40% off the highs. This is a rare opportunity to buy this powerhouse business at such a discount. I think Disney is going to have a very big holiday quarter. As someone who goes to the parks frequently, I can tell you firsthand they're not hurting for business. They're doing a great job of increasing monetization per guest in the park. Not a great thing if you're at the parks and spending money, but as a shareholder, that's something they're just showing they're flexing their pricing power right now. And going into the holiday season, I think they're going to have an excellent quarter, not only in their theme parks, at the box office. They have a few big releases coming out in the holiday season that could really translate into some money. And their streaming service is kind of the cherry on top. They're raising their price of Disney Plus, introducing an ad supported tier. Disney has the best pricing power, in my opinion, of any streaming provider, and they have more intellectual property than any other streaming provider as well. So I think there is a lot of overlooked potential in Disney right now. So that's number three. Number four on the list is Airbnb. This is the only stock on the list that I don't own yet. Airbnb is down 55% from its 52-week high, and there are some good reasons. The guidance it gave in its fourth quarter earning or in its third quarter earnings report was a little bit weak. The fourth quarter is seasonally weak anyway, so now it's going to be even weaker than expected. International travel still kind of lags based because of a lot of COVID situations overseas. The travel recovery that we saw in the reopening in 2021 and early 2022 is definitely slowing down. And but there's a lot to like about the earnings report. The third quarter was the company's strongest ever, highest revenue ever, up 29% year over year. It's profitable. The earnings were well above expectations, and there's still a big opportunity to disrupt the travel market for Airbnb. I think it's a great opportunity to get into this kind of mega disruptor at a discount. And last but certainly not least, number five is Amazon, ticker symbol AMZN. Amazon is down 50% from its highs, which is a rare discount in such a dominant company. And Amazon dominates in two businesses, which is even more rare. It is the dominant e-commerce player and a dominant cloud services provider through its Amazon Web Services or AWS business. There's a lot to like from its earnings report, even though the market didn't really agree because of lower margins and just profitability concerns. But its sales were up 15% year over year in the third quarter. 74% of its e-commerce business is still in North America. A lot of people don't realize that. So not only does e-commerce only make up about 15% of US retail, but e-commerce also has a lot, or Amazon's e-commerce business has a lot of potential overseas. Amazon Web Services was up 27% year over year in terms of revenue in the third quarter. And although its margins are under pressure, I think that's a temporary headwind because of some, increased shipping costs and inflation and things like that. Its fourth quarter could surprise people. The year over year growth is expected to be relatively weak, about 2 to 8%. But I think Amazon is still a long term winner that is really worth a closer look at these levels. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 3 times. So go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 354% as of 9/12/2022 and are measured against the S&P 500 returns of 112% as of 9/21/2022.